The COVID-19 pandemic upends the global oil market, crushing demand while supply remains high.
The collapse in demand is completely unprecedented.
These are wild and crazy moves. This is truly a global problem, and we need a global solution.
Prices plunge, dragging down producer profits.
We've all given up trying to predict the price of oil. I think we learned that early in our careers, and we certainly don't control it.
While we didn't expect this exact circumstance, we were prepared for it.
How did it happen, and where do we go from here? Join me for a coronavirus special report, Crude in Crisis. Hello and welcome, I'm Alix Steel. COVID-19 brought the global economy to a screeching halt, and one industry hit particularly hard was oil. The coronavirus, oversupply, leverage, and technicals all played a part in this historic catastrophe, and it all came to a head April 20th. Black Monday, the day oil prices went negative. Here's how we got there. First, February. The coronavirus already shut down most of China. Everyone still expected a V-shaped recovery, and most still thought this was just a China story. Towards the end of the month, cases in Italy started rising and prices started to roll over. The ugly March. March 6th. Prices fall the most since 2008 after Saudi Arabia and Russia were unable to reach a production cut deal. This led to super contango, where prices today are $10 or more cheaper than prices a year later. Soon after, the WHO classified COVID-19 as a pandemic. A little over a week later, the Fed's surprise Sunday rate cut failed to protect markets. President Trump warns the U.S. will be fighting the outbreak until August or later. Equities sink and Brent breaks below 30. Cases and the death toll rise all over Europe. California and New York now shut down. Then comes April. Demand craters, storage starts to build. Some U.S. oil producers call for a joint Texas cut. President Trump helps broker a deal between Russia and Saudi Arabia amounting to a global cut of 9.7 million barrels of oil a day, more than 20%. It's too late. April 20th. The day before May oil futures contracts rolls over to June. If a trader hasn't already sold the contract, they could be on the hook for taking the physical oil, only this time there's nowhere to put it. Selling intensifies. May U.S. oil prices hit a record low of negative 40 until demand recovers. It's oil in crisis. Every week, 50 million barrels of oil go into storage. Tankers float at sea filled with oil. Bankruptcies mount, producers slash rig counts, and axe future investments. Some even cut their dividends. Here are what some big industry players are saying.
You'll never see that again in history, I don't believe, where they have to pay you. They have to pay you to take their oil, which was up to $35 a barrel. I mean, it was just an interesting point in history because, again, you've got to look at risk-reward. And sometimes when you do those futures, and you know, they have funds that do the futures, and the same darn thing, again, as you had in '08 or in any of these times before the market really breaks. And you know, playing in the future market in the oil game, or in any commodity for that matter, is not for the faint of heart.
We've all given up trying to predict the price of oil. I think we learned that early in our careers, and we certainly don't control it.
We just refuse to sell our crude at these kinds of prices.
While we didn't expect this exact circumstance, we were prepared for it with a strong balance sheet, a low break-even, and a flexible capital program.
I wouldn't get too excited about a price recovery anytime soon.
The collapse in demand is completely unprecedented. I think you're going to see patterns change. For example, I've been advised that in certain countries, as soon as people can get out of their houses, they're going to go down and buy automobiles because they don't want to get on public transportation. They don't want to get on buses. So we're going to see consumption patterns change. I think the other side of the coin is that if the oil industry cuts back too much and there isn't investment in production, eventually that could come back to bite us as well. I mean, supply and demand is still going to be fundamental, but it's this collapse in demand which, because of the COVID and the global recession.
Our expectation is that we see a softer market in June relative to the announcement that we made in May. So we'll fully expect that we'll be curtailing more production when we hit June, just given the early indications that we see on prices for that particular trading month.
Everybody needs to pitch in. This is truly a global problem, and we need a global solution. We are calling for a roughly 20% cut from the state of Texas, and candidly, that might not be enough. What we need is a symphony of solutions. Operators have to do their part. They have to cut. States need guidelines so that this is done in an orderly fashion and fair across the board. On top of that, other countries need to pitch in: Canada, Norway, Mexico, Brazil, and of course, the big kahuna, OPEC plus.
Some producers are going to have to cut 10%, some are going to have to cut 20%, some are going to have to cut 30%, and some will not be able to sell their oil because they don't have the power or the stroke or the contracts to get their oil to the Gulf Coast. So there's going to be all types of ineffectiveness or unfairness among all the producers in the state of Texas. Something has to be done, and it has to be done fairly. If not, the small and medium producer will not be able to sell their oil, I predict, for several weeks to months until this virus ends.
We have a situation where we have excess supply. Inventories and storage are filling up. Cushing is 70% full. People think will reach completely full sometime in May. And we're very fortunate to have a very large trading organization and have been able to find a home for our crude, a physical home for our crude. But not everyone is that fortunate.
We came into this with the strongest balance sheet in the industry, a very low break even, and a very flexible capital budget. So we're in control of those choices. And the market signal right now isn't calling for more near-term production. So that's why it makes sense to reduce capital in the short cycle part of our portfolio.
Our break even in 2019 was around $56. So going to 35 by next year, I think, is the right thing to do, and we'll drive it lower if we can. The economic uncertainty here, I think, is immense on how this recovery is going to play out over the coming months. But we're very focused on the basics of the business.
We'd definitely be willing to adhere to state's 20% if they land at that number or a larger number. We've already cut our CapEx 66% on a go-forward basis, and then we've already started shutting in about 400 lower producing wells. These are low-margin wells, even though 90% plus of our wells, of our volumes, have below $5 operating costs.
So we'll see production here in the month of May down probably 200 to 300,000 barrels of oil equivalent per day, and June, same range or perhaps even a little bit greater than that.
We're going to take capital down by 25% this year, maybe another $1 to $2 billion next year. We're taking $2.5 billion out of our cost base by the end of next year, and we think we can get our business to a break even. Capital is obviously a huge lever for us. Planning to spend around $15 billion. We'll take that down to 11.5. We'll take $1 billion out of our lower 48 business, for example.
There's too many names for investors to invest in these days, and these assets need to be run more rationally. They need to be run for improved financial returns and better capital allocation. So I think there is room for consolidation in this business. And, but I imagine today the conversations inside the boardrooms and management teams all about, what do we do tomorrow and not think about the long term. So I don't think anything's going to happen really quickly, but structurally something needs to happen in this business.
There will be no consolidation because people do not want to buy companies that have too much debt. And so there'll probably be only 10 independents left. What's important is energy security and energy independence. I don't want to get back, since I've been in the industry for over 40 years, I don't want to get back to importing 60% of our crude oil from the Middle East and be highly dependent upon Russia, Saudi Arabia, and Venezuela to supply our gasoline needs for the next 20, 25 years.
I think oil markets will be well supplied as we come out of this, and so the price signal will be modest as we go through a recovery. But we've found ways to make the Permian Basin highly competitive. It's attractive, and even at low prices can carry positive economics with it. And so I think the fundamental equation there is strong.
Coming up, not all oil companies will survive. Bankruptcies, restructuring, and M&A. How the crisis in crude will reshape the oil industry. This is Bloomberg. Welcome Welcome back to our coronavirus special report, Crude in Crisis. I'm Alix Steel. Even before the pandemic, U.S. oil and exploration companies faced some major debt problems. The sector went on a serious debt binge over the last few years, and investors were more than happy to pour money into it. And now the balance sheet is coming home to roost. Funding is drying up, investors are demanding capital constraint and shareholder payouts, freezing out companies that have heavy debt loads. Bankruptcies are starting, and not everyone will make it. Janine Way, Barclays Senior U.S. Integrated Oil and E&P Analyst, gives me her take.
This earnings season has been exciting. We're in the throes of it right now. We've had a few good earnings prints where we see some winners. Execution still really matters in this space. The companies really need to hit their numbers in order to instill confidence from investors. And so in that case, we highlight Devon, who this week, they reported very strong numbers. They beat all around on cash flow, CapEx, oil production, and they continue to show a really good track record of execution. Also, oil prices are still very low, and cash is king, and specifically free cash flow is king in the current environment. And we'd probably highlight this week that Parsley announced another CapEx reduction, and now the company expects to generate over $300 billion of free cash flow at $20 to $30 TI for the rest of the year, which is pretty impressive. And so we think there should be some follow-through on that.
Who doesn't make it?
Well, in terms of not making it and bankruptcies and all of that, after selling a bunch of assets and repositioning portfolios on our large cap E&P side, we have decent balance sheets. And so we don't see a lot of near-term risk for bankruptcies. And what we've been seeing also is that some companies are able to successfully tap the debt market recently. But with that said, the more highly levered names with near-term debt maturities, we're watching those names because they could be more exposed, depending on if oil prices remain challenged and if the markets are actually close to them. So, for example, Oxy has above average leverage, and they've got $6.4 billion of debt coming due next year and $12 billion coming due over the next 3 years. So that's a name that we're going to watch just on how oil prices do. But, that company, like others, they still have options, and they continue to work asset sales. They're lowering costs. They're lowering CapEx. They're trying to preserve the cash. But really, they just need higher oil prices.
Right. So let's make that distinction. Like, who can restructure their debt? Who's going to be able to declare Chapter 11 and who's doing Chapter 7? Like, total, here are the keys, I'm walking away.
Yeah, we just don't see very much of that on the large cap side. In terms of the companies that are able to restructure debt, we saw EOG come to the market successfully. We saw Exxon come to the market successfully. So we still think that the debt markets are going to be open for the high quality companies. Equity is a whole other story, but there's still options.
After the reckoning, what is left? Warwick Investment Group founder and CEO Kate Richard tells me what could follow.
A lot of the control and the future of what happens to many of the companies that Reuters and others have predicted will be part of that 30% oil and gas company bankruptcy stat is held by the lenders. And more than the bondholders, it's really by the senior secured lenders for the small cap, mid cap public companies, and then also for many private companies. And it's a question mark. You can talk to the lenders right now. It was widely reported that some of the large lenders, like the investment banks that are involved in senior secured lending for oil and gas, are setting up operated companies to actually own and manage the collateral of oil and gas assets that they might be seizing. If the lenders want to put people out of business because they're in violation of covenants, they'll be able to do that, and that could create an interesting distress cycle. But that's not something that we've seen. I mean, we didn't even really see that in a widespread way coming out of 2008 or coming out of OPEC's kind of first price war in 2014 and 15.
Does this mean that basically at some point you could buy really, really cheap oil assets from banks? Like, is this what we're going to be looking at in like 12 months?
Yeah, so the big thing that people are talking about in the industry right now is can you buy PDP? So can you buy just production at a high teens discount rate? And right now there are about 6 transactions that we can point to where that has been done. And so I would say in general that is I think it's a big theme, and everyone's saying you shouldn't pay anything for acreage, which is undeveloped, proven resources. you should only pay a high teens discount rate for your PDP. And what we're seeing in reality is that is a widely talked about idea that hasn't really been transacted on that much. Of course, we're watching it. And that's, a high teens return on production would be significant because production historically is priced at, a 9% return or a 10% return.
Coming up, what the crisis in crude means for investors, from hedge funds to private equity to one famed investor often referred to as God. This is Bloomberg. Welcome back to our coronavirus special report, Crude in Crisis. I'm Alix Steel. Since crude's historic crash last month, there are signs that the massive global supply glut may be beginning to ease, largely due to output cuts taking effect. But will we ever get back to a normal oil world? Here's legendary oil investor Andy Hall, now an advisory board member for Orbital Insights.
It all depends what you mean by normal, of course, and whether the oil world has ever been normal. But I think the negative prices we saw on WTI last week. It's unlikely we'll see that again, although not impossible. This was a bit of an unusual situation. It was an expiring contract, and strange things happen when futures contracts go into expiration. They're relatively thinly traded. So I think, dramatic as it was, you can probably read too much into this, and probably a better measure of the market is the next month's contract, or maybe the rolling 3-month contract. I don't think we're ever going to see that going negative, obviously. So as I say, I don't think one should over-dramatize the fact that the expiring futures contract went negative for a few hours.
So, Andy, I'm looking at CCRV. It's the function on the terminal that shows me the oil curve, and I'm looking at it today versus a month ago. And what we've seen is a big re-rating in the back end higher. Why?
When a market like oil goes down, the back's obviously always outperform the front of the market. And I guess also there's probably a thought now that with production being shot in, with rig counts falling, with investment in future supply being reduced, we're potentially setting ourselves up for some sort of shortfall in the future. And I guess theoretically, at least, that is a real risk. That we're setting ourselves up for a potential future supply shock. To anyone who strongly feels that way, though, I would say that all this production is not going away. It's all potentially there, and it can be brought back fairly rapidly. But in the short term, there's a certain logic to the idea that underinvestment over the next year or two could set us up for some sort of supply crunch in the future. But personally, I wouldn't bet on that. The problem with all this is always in the timing, because if we do have some sort of supply shortfall at some future point, it's going to manifest itself in the nearby contracts, not in the deferred contracts.
So is there anywhere in the commodity space, Andy, that you do like right now?
To be honest, I think there are easier ways to make money right now than in the commodities market. Oil, as you pointed out, we saw oil go negative $40 last week, albeit in the expiring contract. And, these are wild and crazy moves. Can someone predict those moves? Possibly. But personally, I think there are, better ways to invest one's money than trying to predict these chaotic movements. And that's what they are. They're chaotic movements.
Many say there will be opportunities in the oil patch, but when, where, and at what price are the big questions. Ben Dell is co-founder and managing partner of Kimmeridge, the energy-focused private equity firm.
Well, I think third quarter, fourth quarter, we'll see a number of these E&Ps go bankrupt. I mean, if you look at the peer group, whether you look at Chesapeake, Callan, SM, Whiting, Oasis, etc., those companies will probably see pressure on their liquidity as you go into the back end of the year. Those companies will probably preemptively draw their RBL and look to file. And when you reconstitute these assets, the questions will be, what do the debt holders want to do with them? We see no real appetite for these companies to be reconstituted as going concerns. So we're going to see a number of asset sales drop out of that towards the back end of the year, or you'll see them merged into other existing companies.
So then how do you distinguish what a good opportunity may be for you as we get to this time where it may be ready to put money to work?
Well, our view, which has been consistent over the last 2 or 3 years, is that you want to own assets at the front end of the U.S. cost curve, those that will survive these types of commodity price environments. The challenge we've had over the last decade is too many E&Ps being focused on growth over returns. Too many uneconomic wells are being drilled. And as a result, we've added supply from marginal basins, from marginal assets. It just doesn't make sense, even at $50 oil, let alone $25 or $30 oil. So the key is to focus on the Delaware Basin, the Midland Basin, the Niobrara, the DJ, and potentially the core of the Eagle Ford. But a number of these fringe assets are never going to be drilled and are just going to disappear from the map.
Do you need a recovery in oil prices and a supply shock to make these investments worthwhile?
You don't necessarily need a material recovery, but I think it's fair to say at current capital cost of drilling wells, sub-$30 oil prices don't work for anyone. Perhaps the biggest surprise in this market today is that there's still 371 horizontal rigs running, which actually underscores the uneconomic activity of upstream operators and the lack of capital discipline. What's also staggering today is we have 123 operators operating in the U.S., which highlights the disaggregated nature of the U.S. industry. In my mind, no one drilling a well today is drilling an economic well. And investors, whether it's equity investors or debt investors, should be questioning why these management teams, why these C-suites, and why these boards are continuing to destroy value after a decade of having done so. So when I look at the forward curve, our view is in 2021, we could see continued pressure on the commodity, particularly because airline traffic is probably never going to recover to historical levels in the near term. You know, our view is we might recover to 95, 96 million barrels a day of demand in 2021, but we won't recover to the historical levels. I think when you look at 2022, with a lack of capital going into the ground now, you're likely to see a real impact on supply, and potentially with demand recovering, you could actually see oil prices higher than the forward strips indicating today.
So what's the best way to access investments? Is it equity? Is it debt? Is it just like going out and buying the land or buying rigs? Like, what is it going to be?
Well, I think the public equity markets are challenging in the sense that you have to be very selective about those companies that are going to survive. And obviously the equity markets have rallied back somewhat in the last few weeks in the commodity. And I think that makes it difficult to put new money to work. I think for most investors, for ourselves, the real opportunity set today is in the high yield market and the loan to own market. I will say in the asset sale market, virtually nothing's transacting, in the sense that public companies can't sell assets today without diluting their financing metrics. So there's really no transactions happening.
That wraps up our special report, Coronavirus Crude in Crisis. Make sure to tune in to Bloomberg Television and Bloomberg Radio and visit Bloomberg.com for all the latest news 24 hours a day. Stay healthy, everyone. I'm Alix Steel. This is Bloomberg.